Hello, welcome to this week's Market Carver. I am Andrew Thrasher, Portfolio Manager for Financial Enhancement Group. I'm joined by Zach Unger, Senior Analyst for the Financial Enhancement Group. We have two good topics to talk about this week. We're going to start out with looking at the labor market. We just got the jobs report for June, and Zach's going to dive into some of the positioning data and look at what's been pushing the market higher and potentially what are the inflections or impact of that going forward. So first thing we want to unpack a pretty big unemployment report or labor market report that came out in June that has some major implications. So what we saw in June is that there were 73,000 jobs added, but one of the biggest takeaways was actually what was done to the May and June report, where we had 258,000 revised down for May and June. We're continuing to see the cooling off of the labor market, and we can see that in the chart here on your screen, looking at all employees going back to 1980, and we can see the gray bars there are recessions. And typically why the labor market's so important is when we start seeing the labor decrease like this, we start to obviously get into periods where it's more at risk for a recession. Now, one of the big questions with the report and with the looking at the revision, having 258,000 revised out of the last 2 months, is what's the impact? Is that really what's happening? How good is this type of data? And lots of different questions on the validity of what the Bureau of Labor Statistics does. But the one thing I do want to note is looking at the unemployment number. That's what a lot of you probably are familiar with. We did see that tick higher to 4.2 from 4.1. Still a very, very low level. We're starting at a very small base for the unemployment rate, not getting quite to levels that we've experienced in major recessions. But the point I want to drive home is looking at the validity of these numbers and what's getting a lot of attention in the media, and we're getting a lot of questions from some of the families that we work with, is going to the next slide. What this looks at, and we think is a really interesting data source, is going back a long ways, going back to the 1960s and looking at the number that was initially reported, and then it gets revised. So when we get the jobs report, it's always on the first Friday of the new month. They're continuing to collect data information and reporting the first kind of look at what the labor market looks like. And then as they continue to get more information throughout the month, it then gets revised. And that's what we saw happen with the big revision in May and June. But what's really interesting is when we start looking at comparing the numbers of what was initially reported and then the final revised number, that those gaps are getting a lot smaller. And that's what this chart's looking at and showing the decline in the percent change for the final reading versus the first estimate. So we are getting, the data is getting more accurate, it's getting better at being reported, and we're not seeing a huge variance anymore as we used to. You can look back in the 70s, it was a big change to what the first estimate was and what the final reading came through once they finally got all that information. So I believe we are getting more accurate with the labor market. But the other facet to this is this information is taking a lot from survey data. They're calling businesses, they're calling consumers. You very well may have gotten a phone call, and like many others, when the phone rings and it's someone from the government wanting to ask you some questions, a lot of people do hang up on that call, and they don't get as many respondents as they would like as we continue to see the data trend lower and the number of respondents answering these calls. And then that's what the information that goes into the statistics to report the numbers that we get each month. And so that number has been trending lower from the people actually answering their phone call. But they continue to still, from what we've seen so far, is getting more accurate, not as large of a variance as it once was. And so we are continuing to really monitor the labor market. It's one of the most important factors for our economy and seeing growth or potential contraction. And so while we are seeing a little bit of a tick higher or slowing down, as that last chart showed for the labor market, we're not yet to levels that would be overly concerning or suggesting a recession is upon us. So it's something we continue to watch every month as we dig into the data and try to understand what's going on in the labor market. So now I'm going to turn over to Zach, who's going to bring us back over to what's going on in the stock market.
Yeah, so one of the things we're really intentional about as the markets ebb and flow is we want to take a look under the proverbial hood to understand which factors are driving the market higher or driving the market lower. And one of those factors that tends to be fairly substantial is systematic trading that's done by large institutions. Simply put, as volatility declines, they will add equity exposure. And then the opposite of that, when equity spikes, or when volatility spikes rather, they will begin reducing exposure. You can see on the chart here in front of you that since the April pullback, when volatility spiked, as it started to come back down over the past few months, they have been adding exposure. They've been buying equities. And what that does is it helps to push the market higher. But as you can see in the top right-hand side of the chart there, they're nearly maxed out in terms of their exposure right now, which begs the question, what is the next factor that can continue to push the market higher? And how is that going to continue to play out as we've seen this systematic trading act as a buoy of sorts to drive the market higher over the past few months?
Always want to be an understanding of what are the factors, what are the themes, what are the catalysts that are moving the market, whether it's flow data like this, whether it's something going on at the Fed, looking at all the supply demand characteristics of the market, looking at valuations. We try to unpack it all and try to get the best understanding that we can for where the risk is, where there's potential opportunities, and what's going to be moving the market in either direction going forward, and trying to do the best we can and share that with our allocation team each week, and then bring to you some of the pertinent details from those calls on these market carvers. So that's what we have for this week. If you have any questions or like to schedule a meeting, please call that number on your screen now, scan the QR code, or definitely visit our website at yourlifeafterwork.com. Until then, we'll see you next week with another Market Carver video. Thank you.